How the stock market works. The stock market provides a venue where companies raise capital by selling shares of stock, or equity, to investors. Stocks give shareholders voting rights as well as a residual claim on corporate earnings in the form of capital gains and dividends. Individual and institutional investors come together on stock exchanges to buy and sell shares in a public market. When you buy a share of stock on the stock market, you are not buying it from the company, you are buying it from an existing shareholder. What happens when you sell a stock? You do not sell your shares back to the company, but instead, sell them to another investor on the exchange. What is a stock? A stock is a financial instrument that represents ownership in a company or corporation in a proportionate claim on its assets and earnings. Stocks are also called shares or equity. Owning stock means that a shareholder owns a slice of the company equal to the number of shares held as a proportion of the company's total outstanding shares. An individual or entity that owns 100,000 shares of a company with 1 million outstanding shares would have a 10% ownership stake in it. Types of stock. There are two main types of stock: common shares and preferred shares. Equities are synonymous with common shares because their market value and trading volumes are many times larger than those of preferred shares. Common shares usually carry voting rights that enable the common shareholder to have a voice in corporate meetings and elections, while preferred shares generally do not have voting rights. Preferred shareholders have priority over common shareholders to receive dividends as well as assets in the event of a liquidation. Common stock can be further classified in terms of voting rights. Some companies have dual or multiple classes of stock with different voting rights attached to each class. In such a dual-class structure, Class A shares may have 10 votes per share, while Class B shares may only have 1 vote per share. Dual or multiple class share structures are designed to enable the founders of a company to control its fortunes, strategic direction, and ability to innovate. What is a stock exchange? Stock exchanges are secondary markets where existing shareholders can transact with potential buyers. Corporations listed on stock markets do not commonly buy and sell their shares but may engage in stock buybacks or issue new shares, but these transactions occur outside of the framework of the exchange. Largest stock exchanges. The first stock markets appeared in Europe in the 16th and 17th centuries, mainly in port cities or trading hubs such as Antwerp, Amsterdam, and London. In the late 18th century, stock markets began appearing in America, notably the New York Stock Exchange, NYSE, which allowed for equity shares to trade. The first stock exchange in America was the Philadelphia Stock Exchange, PHLX, which still exists today. The NYSE was founded in 1792 with the signing of the Buttonwood Agreement by 24 New York City stockbrokers and merchants. Before this official incorporation, traders and brokers would meet unofficially under a buttonwood tree on Wall Street to buy and sell shares. Today, there are many stock exchanges in the US and throughout the world, many of which are linked together electronically. The NYSE and NASDAQ are the two largest exchanges in the world, based on the total market capitalization of all the companies listed on the exchange. Over-the-counter exchanges. There also exist several loosely regulated over-the-counter, OTC, exchanges, which may also be referred to as bulletin boards, OTCBB. These shares tend to be riskier since they list companies that fail to meet the more strict listing criteria of bigger exchanges. Larger exchanges may require that a company has been in operation for a certain amount of time before being listed and that it meets certain conditions regarding company value and profitability. In most developed countries, stock exchanges are self-regulatory organizations, SROs, non-governmental organizations that have the power to create and enforce industry regulations and standards. The priority for stock exchanges is to protect investors through the establishment of rules that promote ethics and equality. Examples of such SROs in the U.S. include individual stock exchanges, as well as the National Association of Securities Dealers, NASD, and the Financial Industry Regulatory Authority, FINRA. Stock market indexes. Indices represent aggregated prices of several different stocks, and the movement of an index is the net effect of the movements of each component. Major stock market indexes include the Dow Jones Industrial Average, DJIA, and the S&P 500. The DJIA is a price-weighted index of 30 large American corporations. Because of its weighting scheme and the fact that it only consists of 30 stocks, it is not a good indicator of how the stock market is doing. The S&P 500 is a market cap-weighted index of the 500 largest companies in the U.S. and is a much more valid indicator. Indices can be broad, such as the Dow Jones or S&P 500, or they can be specific to a certain industry or market sector. Investors can trade indices indirectly via futures markets, or via exchange-traded funds, ETFs, which act just like stocks on stock exchanges. A market index is a popular measure of stock market performance. Most market indices are market cap weighted, which means that the weight of each index constituent is proportional to its market capitalization. Keep in mind, though, that a few of them are price-weighted, such as the DJIA. In addition to the DJIA, other widely watched indices in the US and internationally include the Why companies issue shares. To make the transition from an idea germinating in an entrepreneur's brain to an operating company, they need to lease an office or factory, hire employees, buy equipment and raw materials, and put in place a sales and distribution network, among other things. These resources require significant amounts of capital, depending on the scale and scope of the business. Raising capital. Many corporate giants started as small private entities launched by visionary founders like Jack Ma of Alibaba, Baba, or Mark Zuckerberg of Meta. A startup can raise capital either by selling shares through equity financing or borrowing money through debt financing. Debt financing can be a problem for a startup because it may have few assets to pledge for a loan. Equity financing is the preferred route for most startups that need capital. The entrepreneur may initially source funds from personal savings, as well as friends and family, to get the business off the ground. Listing shares. Companies can access larger amounts of capital than they can get from ongoing operations or a traditional bank loan by selling shares to the public through an initial public offering, IPO. This changes the status of the company from a private firm whose shares are held by a few shareholders to a publicly traded company whose shares will be held by numerous members of the general public. The IPO also offers early investors in the company an opportunity to cash out part of their stake, often reaping very handsome rewards in the process. Once the company's shares are listed on a stock exchange and trading on the market, the price of these shares fluctuates as investors and traders assess and reassess their intrinsic value. There are many different ratios and metrics that can be used to value stocks, of which the single most popular measure is probably the price-to-earnings (PE) ratio. Stock analysis tends to fall into one of two camps: fundamental analysis or technical analysis. How share prices are set. The prices of shares on a stock market can be set in several ways. The most common way is through an auction process where buyers and sellers place bids and offer to buy or sell. A bid is a price at which somebody wishes to buy, and an offer, or ask, is the price at which somebody wishes to sell. When the bid and ask coincide, a trade is made. If you find this video useful, don't forget to like and subscribe to our channel.